Today, we're going to be talking about the financial impact of the Building Safety Act, the wide-ranging legislation put in place following the Grenfell Tower tragedy. The discovery that many high-rise residential buildings have worrying fire safety defects has created a huge liability for developers that runs into many billions of pounds. While the primary consideration must always be to safeguard lives, that moral responsibility doesn't relieve firms or company directors of other legal duties. They have to represent any financial risks posed by building remediation accurately in their financial accounts and also act in the interests of shareholders. Joining me today to discuss this topic is Phil Westerman, partner and head of real estate at accountancy firm Buzzacott. Hello, Phil.
Good morning.
To start with, can you tell us a little bit about Buzzacott and your role at the company?
Yeah, sure. So Buzzacott is a top 20 chartered accountancy firm based in St Paul's in London. I work as a partner in the corporate assurance team, and I also head up the firm's real estate sector group.
Now, the Building Safety Act received royal assent more than a year ago, but there's still a lot of uncertainty about what it implies. What are the big grey areas for you?
So yeah, you're absolutely right. There's a huge amount of uncertainty still, despite the pledge that was signed up in March, April 2022, and the more recent signing of the long-form agreement by all of the major developers that were on the list, 49, I think, of them. So, whilst I think it's fair to say people saw this coming, they knew that there would be consequences of the tragedy. There is a lot of grey in terms of what happens next, who needs to do what, where the obligations actually rest. I think the main developers are aware that they have both a moral obligation and now a legal obligation for the buildings that they're responsible for going back over 30 or so years. That the big greys, I think, are going to be around which buildings are the obligations of which developers. There's some uncertainty there. A lot of these sort of projects are done through joint ventures, so how much of those obligations will rest with the primary developer and how much will be the responsibility of other parties who were involved, which elements can be recovered through the Building Safety Fund that was established to remediate certain buildings urgently that were identified as having problems. And then the sort of financial consequences in terms of how the rectification work is done, by who and by when, how those buildings are prioritised in terms of which ones need doing most urgently. And then the other grey, I think, is probably around that the recent changes to expand the scope of the legislation to cover buildings over 11 metres high, as well as the original over 18 metres, which was what everybody was working to in terms of expectation.
It can take a long time to fix a building's once safety failings have been identified and work out ultimately who should foot the bill. Does this mean lots of firms will have to carry potentially overlapping financial provisions on their books until it's agreed who will pay for what?
There is of course a risk of that. I think the legislation has been written in a way that it should be possible, albeit not easy, to identify who the obligation rests with, and then work through the process of determining how much of that obligation rests with primary developer and how much should be either a shared cost. People are going to be writing to their joint venture partners to determine, where that obligation sits and drawing the lines. I think primary developers will be required to book or recognise a provision and an obligation, and then there will be that continued uncertainty about who ultimately pays the bill. So they will most likely, I think, probably settle the costs of remediating a building, and then if there is recourse from others, we'll pursue that through various avenues, whether that's subcontractors, other parties, Building Safety Fund, etc. So in principle, it should be possible to define the obligations that sit with an individual corporate, but in reality there is a chance that multiple companies will book provisions for the same thing.
Now, do firms need to put money aside in their bank account, or is it generally sufficient to record a financial risk?
Yes, I don't believe there's any requirement to ring-fence a bank account to settle the amount. I mean, partly because by nature, this will involve a huge amount of estimation in terms of what that cost will be. Firms will be required, and it is sensible for them to start ring fencing monies in terms of the future costs that they're going to have to incur. Their ability to do that, and some are likely doing it already in terms of how they're modelling their cash flow forecasts and what they will need to spend their money on. But in reality, it will be driven largely by the financial resources available to them, their other commitments, how much they can put aside or save in relation to meeting these costs.
And how do you account for bills you've actually paid that you hope to get back from third parties through the courts or from insurance companies, say?
So this will be driven by the accounting requirements ultimately. So that the requirements to recognise a provision will be driven by your obligations, either constructive or legal, in this case probably both, your ability to make a reliable estimate of how much money you will need to spend, and the third one being is there or is there not a likely outflow of economic benefit, i.e. a real cost. Yeah. I think it's pretty clear the answer to all of those is yes in this instance. In terms of recovery of monies, it's a slightly different bar that's set in terms of recognising those assets on your balance sheet. So you need to be virtually certain of recovery of the money. So a good example would be if there is an insurable position or potentially recovery from an insurer, you would only recognise that recovery or that asset on your balance sheet at the point the insurers have agreed, that the earliest point at the when they've agreed it, or even go as far as when the cash is in your bank account.
And can you credit your accounts ahead of a payout, or do you have to wait for compensation to arrive?
You can credit ahead of a payout, but only when you've got pretty much absolute certainty.
You have to be confident.
You have to be confident and have something in writing that your insurers say have agreed in writing that they will settle the claim.
How has the cladding scandal affected the stance of insurers in general, given the sums involved? I imagine they're keen to avoid liability and to explicitly exclude it going forward.
This is very much an evolving position. Certainly a couple of examples of people I've been speaking to where insurers have gone a little quiet in terms of responsiveness to questions. I think they will inevitably be reviewing the policies that they have in place. There's a potential impact on premiums going forward. As far as I'm aware, insurers have not been paying out so far, but it is very early days, and I suspect a position will evolve, as it often does in instances of this nature, where the insurance industry will be keen not to be liable under policies in place. And I think we'll have to just wait and see. But there is inevitably going to be an impact on, how policies are written, what is covered. Specifically excluding things will be difficult. I think on the basis that it's construction, it's property development. There are certain things that typically would be subject to be able to be claimed on insurance, and some that just aren't.
And do you think banks and other financial institutions are generally understanding of remediation risks and suspicious that costs may snowball?
I think that this comes down to, again, we touched on it earlier, just the uncertainty with regards to how this will play out, not in terms of the fact that remediation work will be needed and it will be done, but how much it will cost, how much impact it will have on an individual businesses, finances and available resources, and how long it will take. So I suspect when lenders are looking at or being asked to provide financing into property businesses, these are all things that will be considered in terms of how much money they're prepared to make available, the terms of any lending in terms of interest rate, and I mean interest rates are high anyway at the moment. What, if any, cross guarantees from other corporates in the group they'd be looking at, or securitisation of assets or whatever. And I think the other one will be there may be an additional request for more information and more detail behind a company's forecasts and projections before the lending decision is made, to try to get some visibility around how the costs are expected to play out.
Can I just pick you up on that? I mean, how do you think you arrive at the right value of those potential costs? I mean, it's up in the air at the moment, isn't it?
Yeah, I think there's obviously a huge amount of estimation going to have to go in. So there's a whole process in terms of identifying the buildings that need remediating, and then trying to cost up the remediation work when you really don't know what you're going to find when you start to take cladding off a building that was built 30 years ago. What do you find behind the cladding in terms of the fire safety systems and other other aspects of the building? Standards were very different back then in terms of the requirements and what you needed to do, and that's probably one of the biggest impacts of the legislation and the cladding issue, as it was originally referred, is far wider than that. As in the big cost is not really necessarily replacing the cladding; it's everything else that needs to be done. And I know a number of developers are mindful that when they go in, they may be identifying other things that perhaps weren't done as they should be or as they would be now. And there's a genuine risk, I think, of scope creep here, where people open up a building and landlords or whatever say, well, surely you wouldn't do that now, why don't you do that? And that there'll be some grey there in terms of what is technically within the scope, and therefore what needs to be factored into the cost, and what would be a nice to have improvement that isn't really what the legislation has been introduced to cover.
And also, I mean, with building costs in general at the moment, I mean, it's thumb in the air when you're trying to sort of establish how much something's going to cost, given the rising costs, inflation, etc.
Yeah, so that plays to the time frame point and the scarcity of resort in the construction sector and many other sectors. So it's not just about identifying the buildings. The contractors and the developers, they do this for a living. They are able to cost up a job, but what they won't know is when will they be able to do that work, and what will the costs be in. I think the time frame has been talked about 5 to 7 years to try to rectify everything. How much will materials cost in 5 years if that certain project is done then, and what will the resource landscape look like in terms of availability of people? And mustn't forget, of course, that these businesses are trying to do their current business as well. So it's not, they can't just drop everything to focus on remediation when they've got live active projects and a well publicised housing shortfall in the UK. So there's a lot of things that come into how they allocate that resource and over what period, and therefore the estimates in the cost increase.
Has Michael Gove's approach to make firms publicly commit to fixing cladding faults been helpful or a hindrance?
Well, I suspect he would argue that he didn't have a choice in terms of making people put their name on public record saying they bought in or not. And I think that the consequences were made pretty clear to the large developers of not signing up, in terms of the sort of latent threat of not being given planning permission for new developments or not getting building safety sign-off approval on live projects. So the developers were left with probably nowhere to go, really. I mean, there was a degree of consultation in terms of challenges to content of the long-form agreement before it was signed up to by many, just to try to clarify exactly or make it as clear as possible exactly what they were signing up to. But yeah, I think that what would the alternative have been was to do this sort of privately and make people commit in private. That probably wouldn't have washed, certainly with the larger listed companies, for example, where the shareholders would have expected to know what is going on.
One of the major changes introduced by the Act was the extension of liability for existing buildings to 30 years. What impact do you think this is having on companies?
I think that the biggest initial impact here will be a bit of head scratching, probably around trying to identify those older buildings, to actually be able to confirm that certainly in some cases they are actually your buildings and you were the developer. But also, record keeping is arguably better now than it would have been. Some records will be hard to find for buildings that are 30 years old. In addition, I think there's a likelihood that a number of those buildings may have changed in scope and had a lot of work done to them since the original build was done. So again, that would add to the uncertainty about what you're going to find when you go in to do what you believe you're required to do. It might not look quite the same as the building you built 30 years ago. So it will add a whole heap of time in the identification process. I suspect it will be harder to cost up the remediation of those projects and to identify exactly what needs to be done.
The liability for new buildings is also extended to around 15 years. Has this changed the way that developers, investors manage and ring-fence risk?
The ring fencing of risk, if you're talking about sort of corporate structures and how you might try to put separate projects in separate special purpose vehicles, which is sort of typical of the sort of real estate industry, as has been proven by this, the property project being in a specific corporate doesn't ring fence risk away from a wider group. The parent companies are kind of on the hook here anyway. So I don't think it will make changes there. It will just continually push firms to evolve their practices in terms of meeting safety standards, making sure that they're absolutely certain that they have done what they need to do, that their records support what they need to do. There's a whole heap of new requirements around, taking photographs when everything's signed off and keeping those sort of digital records of evidence trail that you've done your job. So I'm not sure it will really change much in addition to what already has been pushed down in terms of the changes that are rightly needed.
It must complicate matters further if some of the safety liabilities cross borders into offshore territories or even between England and Scotland, for example, where there are different building safety regimes. Is this an issue?
Again, I think that's it's early stages. The businesses will be working out what safety standards they need to comply with and where. The English-based businesses will be focusing on the requirements here right now as a start point, and then will likely tweak what's needed to make sure that if they are in an offshore jurisdiction or over the border in the UK, that they are complying with everything that is needed. But that's something I think that will evolve over time.
Great. And do you have any parting thoughts for us?
I think we've covered probably most of the main points. The biggest thing here, and talking as an accountant, the biggest thing here is the degree of estimation and judgment that's going to be required for businesses in recognising these financial liabilities on their balance sheet. For the corporates themselves, it's a huge amount of commercial exposure here in terms of cash out of the business, and managing those conflicting demands between running their businesses and complying with their historic obligations. So, there needs to be a lot of thought, there needs to be a lot of time and effort put into this. Everyone's recognised that, and it will have an impact on businesses for many years to come.
Well, thank you, Phil, for joining us today, and thank you for watching.